All right, hello everybody, and thank you for joining us today. Just a couple of housekeeping items before we get started. All of you should be muted when you join, but if you weren't, if you wouldn't mind muting yourself just to kind of help keep down on the feedback during the webinar. But I would like to thank you guys for joining us and making the most of your cooperative webinar. My name is Derek Layton, and I will be presenting this webinar today with my friend and colleague, Michael Young. In this webinar, we are going to give you an overview of all the FHLB products available to you at FHLB, or as Michael likes to say, we are going to get to know the tools in your FHLB tool belt. And just a quick little background on Michael and I. Michael joined the bank in 2012 and has held various positions throughout the bank in several areas. Those are including accounting, enterprise risk management, and lending. Michael was promoted to Senior Lending Officer in 2018, and he continues to assist members with viable strategies and product education to maximize the value of their FHLB membership. And as for myself, I started out in the banking industry in 2014 at a local community bank and joined FHLB in 2018 as a lending analyst and was promoted to lending officer in 2020. And like Michael, one of my main goals is to assist our members with current and up-to-date funding strategies, as well as providing education to our members so they can maximize their FHLB membership. And every time I do a webinar, I do just like to start off with FHLBank's mission statement, and that is FHLBank Topeka makes a difference by providing reliable liquidity and funding to help our members build strong communities. And, both with Michael and I working on the lending desk, he as a senior lending officer and me as a lending officer, our goal is to be your trusted financial partner. And we do understand, we aren't blind to the times that are going on right now. We do understand in 2020 and even in 2021, liquidity might not be what you need right now, but there are still various ways FHLB can help you strengthen your balance sheet and provide other services that will help you excel at serving your customers and building those strong communities. We are constantly in communication with our membership and can provide assistance and advice on a wide array of topics, not necessarily just liquidity. If you have any questions or are interested in what we hear is working within our district, please don't hesitate to reach out to your regional account manager or us on the lending desk. And on the slide here, just some potential funding uses at FHLB. The main one being contingent liquidity, asset liability management, and as well as any special events that you guys may have. If something crazy or out of the ordinary comes up, I guarantee we have a product here at FHLB that will be able to help you guys out.
And yeah, if we go back to that last slide, I think one thing that's very important to remember when doing contingency planning, especially in the ALCO arena, it's important to keep in mind that liquidity and interest rate risk are included and should be involved in that plan. So not just liquidity, but also interest rate risk. And contingency planning and interest rate risk is at the forefront of regulators' minds, and it will not dissipate anytime soon. So we anticipate even a greater focus on that in the future. And with rates being so low, now is a good time to go ahead and position yourself for long-term success and prevent margin compression.
For sure, definitely some good points. Thank you there for that, Michael. And now here, just on this next slide, just a couple key benefits that our members receive as being a part of this cooperative model that we have here at FHLB. That is the easy to use funding. You guys can borrow on the overnight line of credit online. We can issue letters online. You can call us. We can get your money to you, fairly quickly within a couple of minutes. So you can have it wired out and at your institution, as well as that low cost funding. Especially when you factor in our dividend effect on all of our advances or products, we are very, very competitive within the market. And probably one of the most things that I know I'm most proud of is we are viewed favorably by rating agencies and regulators.
Yeah, and on that point, there is some articles written by Kevin Parks and our member solutions team on how advances are more core than core deposits in certain situations. And those are great. We've had many members show those to their regulators, and just a good resource. And that's out on our main page under advances, and member solutions has a site where you can access those, and also available on our financial intelligence page.
Yep, and that's a great point. Our website has kind of a wealth of articles and knowledge. If you guys ever need to brush up on anything. And now we are just going to kind of get into all the advanced products that we have here at FHLB. And this first one here, which a lot of you are probably already familiar with, that would be our overnight line of credit. There's a couple key features on the overnight line of credit. It does have a $100,000 minimum. It can be drawn on or paid down daily. The only catch to that is that if you do draw on it, you have to leave it outstanding for 1 day before you can pay down. There is no charge to establish the overnight line of credit. And kind of the biggest use we see our members for this is just your daily cash management. You can help with all those cash flows and everything like that on a day-to-day basis. And I know, again, in 2020 and in 2021, we know a lot of you are extremely liquid right now. But when your auditors do come into your institution, they are going to want to see that you guys have extra liquidity, and a test your line transaction is a great way to do that, to know that you do have, ample extra liquidity if you guys ever needed to use that.
Yeah, and I could go on a rant about the test your line transaction, but I think it's even more important nowadays to show examiners your ability to use those tools that you have in your tool belt with FHLB. So whether that be some of the other products that we'll discuss later on, and even small amounts to help with maybe sensitivity, right? I think banks and other institutions are less asset sensitive than they were pre-pandemic, meaning they're putting on longer term fixed rate assets than they've done in the past, trying to capture yield or have a security portfolio that they didn't otherwise have as they try to deploy that excess liquidity. And so I think there's a little more to it than even just to test your line. You could take that a step further with a few strategies we discussed later on.
Sure, definitely some great points. And just real quick here, Michael, if you don't mind, it seems like we do have a question in the Q&A asking for the meeting passcode. If you're able to, Michael, would you mind answering that while I go through these next couple of slides? Thank you. All right, and on to our next product we have here at FHLB. That is going to be our bullet advances, which you can see on the screen here. They kind of come in two different structures. That is our short-term bullets, which go from 3 to 93 days at $100,000 minimum. And we also have our long-term bullets, which are 94 days all the way up to 30 years. So you can definitely have a wide range of dates there to meet your guys' needs. And on that long-term bullet advance, the minimum is that $10,000. And there's a couple of kind of quick key features about the bullet advance, which some of you might be already aware, but those of you who are not aware, on the bullet advances, kind of how the payment structure works is that interest is due on the first good business day of every month. And then final interest and principal will be due at maturity. And just some kind of common uses, or at least the most popular uses that we see our members using these bullet advances for, just general balance sheet funding. For example, if you guys notice you have a bunch of assets maturing at a specific time, say that 5-year period, but you don't have any liabilities to match up with that, a bullet advance is definitely a great way to fill those holes on your balance sheet. Oh, and one other thing I did want to add about these bullet advances, kind of the biggest difference between the short-term and long-term is that the short-term bullets, they are not prepayable. And the long-term bullets, you can prepay those, but they may be subject to that prepayment fee. All righty, and moving on, we are going to, our next one here is our amortizing advances. In this current rate environment, we have seen a demand from your customers that are demanding for more longer term fixed rate loans. And definitely a great product here to hedge against changing rates, lock in today's low rates when eventually, I think we're all kind of expecting that they are going to rise in the next couple of years. There's some details on amortizing advances. They can go out to 1 year and again out to 30 years at that minimum $10,000. And we can set up your payment schedule kind of however you're wanting. That may be monthly, quarterly, semi-annual, or annual. And again, the greatest benefit I think our members see out of our amortizing advances is the customizability with these. We can set these up almost identical to the asset or loan on your side. So we can set up balloon payments. We can delay your first payment. You can delay it a month, 5 years, whatever you're needing. Again, that payment schedule can be set up monthly, quarterly, semi-annual, or annual. So essentially we can, again, set these up to whatever you're needing on your end to kind of match fund or blended funding. Any strategy is you can kind of just set it and forget it.
Yeah, and they're very customizable, like Derek said. And then one key thing here, and he might have said this and I missed it, but we discussed earlier that bullets advances are callable or prepayable in part or full, where amortizing advances are callable. They have to be prepaid or called in full. And we'll just get into those details later, but that's something to point out. So you can't partially prepay an amortizing advance.
Yes, thank you for bringing that. Is something I did forget to mention. So yeah, thank you for bringing that up, Michael. All right, and speaking of callable advances, that is going to be our next product that we go into here. And again, these advances can be set up as a bullet structure or amortizing structure. So again, you can get both of the benefits of those products with an added call option on those. And as you guys might have seen, we did run a special on this product back in April, the last 2 weeks of April. We did have some success and interest in that back in April, and then so we decided to run that again in June, except for this time we did it for the entire month of June. That's a little bit longer. And the great benefit of this callable special is you get to take 8 basis points off any callable advance, whether that's amortizing or bullet. You take 8 basis points off the regular rate. Another great benefit about this special we have going on right now is you get quarterly call options instead of the semi-annual call options at no added cost. So you get twice as many call options to give you guys even more flexibility to prepare for whatever might happen down the road. And again, the callable advances, kind of a great benefit to them, is a great way to hedge against prepayment or interest rate risk. As the kind of economic headwinds of this COVID-19 pandemic begin to subside or ease, a lot of our members are taking a close look at how to best position their balance sheets to mitigate net interest margin compression and prevent underperformance in a rising rate environment. Again, just the callable advances gives you guys a lot of flexibility to prepare for whatever might happen down the road.
And I think we learned a lot could happen very quickly in 2020. So it's just cheap insurance.
Yep, for sure. And on this next slide, we're just going to kind of show you some pricing with our callable products right now and the special we have going on right now. So on this table here, just kind of how to read this table is that first column. I'll just kind of go through it and give you guys an example here. That 4-year, 2-year bullet row, that first column, what that is telling you is a regular 4-year bullet would cost you 95 basis points. And if you want to add it, so that means after the 2-year lockout period, you guys get your call options. That would only cost you 10 basis points, which that is the lowest we are allowed to charge on a callable advance. So it's not going to get the cost of the call can't get any cheaper than that. So definitely that 4-year and 7-year callable is kind of our sweet spot we have right now. And then just so on to this next column here, you add that 95 and that 10 basis points, that's going to give you your regular rate of 105. And then with our current special we have going on right now, you take 8 basis points off that. So really you can take down a 4-year, 2-year callable bullet for only 2 basis points more than the regular price at that 0.97. Another thing we always do like to stress here at FHLB2 is that great dividend that we have. And assuming if you guys would take this down and would be all supported by our higher paid Class B dividend stock, your all-in rate with the dividend effect would be at 0.74%.
And we'll get into that later on. And Derek, we just had a question on, are these the only structures available? And we picked these structures just they are most common, especially when competing with Farm Credit or other institutions. These are just the most common, but there's a wide array of structures you can use. So it's not limited to, the special is not limited to just these structures. And we'll get into greater detail later on why we pick these structures, but you can use any structures, and that special is going on until the end of the month.
Yeah, definitely a great point there, Mike. Like I was saying earlier on the previous slide, the special does apply to any callable advance. So that can be a 20-year, 5-year call, a 20-year, 6-month call, 2-year, 1-month call, whatever it may be, you guys would get that 8 basis points off the regular rate.
And then you'll just email the desk and we'll get you those rates.
Yep, email or give us a call and we can get you some rate indications for sure. Alrighty here.
And then here we'll talk.
Yeah, go, Michael.
Oh yeah, we're the forward settling advance. This is a great product. It allows you to lock in the rate today and settle it up to 2 years in advance. Now you pick that settlement period, so you could settle it in 1 year or whatever. It just can't be greater than 2 years. So there's no interest rate or interest expense, collateral, anything. It's a commitment that you're just locking in the rate today and settling it in the future. And there's a slight premium on that. I think Derek was going to cover this slide and I just took over for him, so I'll let him finish this one out.
No, you're right. Appreciate it, Michael. Yeah, but as Michael was saying, you can delay your funding out up to 2 years. And again, kind of the main feature of the forward settling advance is you get to lock in today rates today without adding that immediate funding, which I'm sure just talking to all of our members and everyone is extremely liquid. So this is a product that you might want to look into for when deposits, all that money starts rolling out. But it's kind of one you're going to want to pick and choose. As Michael was kind of saying, the premiums on this right now, because rates are so low, are kind of high, just because again everyone's expecting rates to go up in the next couple of years here. And then move on to the benefits here. I think Michael was saying this on the last slide again. There is no interest, collateral, or stock required until settlement, so you guys don't have to worry about covering that for your delay period. Again, protect against rising rates. And kind of the main reason this product was actually created was to allow our members to be competitive with construction and perm loans. Kind of the main focus for this, and it's kind of expanded after that. And again, as that previous slide stated, this is custom, or you can set this up in a bullet or amortizing structure. So you can all the customizability those two products offer. You can throw that into a FSA advance. And then as well, this last point here, again, deposits eventually will probably start running off. So you can mitigate your risk by securing known funding costs for future loan or production runoff.
Yeah, and as we reference back to the tool belt comment and understanding tools, I know we've all used the wrong tool for the task at hand, but this tool FSA has evolved into several other uses, like Derek mentioned, like replacing brokered deposits, replacing a portion of CDs you're expecting to roll off in the future. But again, you're locking in the funding, so we want to ensure that you have that asset in place and the need, and understand that rates can change at a minute. So you're comfortable and everything's secure on your end and you're using it for the right reasons and understand all the risk associated.
For sure. And then so now I'm going to toss it over to Michael, and he is going to kind of go over our newest product we have here at FHLB, which I believe we introduced back in June of last year. And that is going to be our SOFR Advance, which is a secured overnight financing rate.
Yeah, and this is as you all know, with LIBOR going away, and they actually are going to start extended publishing rates to June 2023. Regulators have made it very clear, do not do anything tied to LIBOR, any loans, and the market's drying up. So we started using the SOFR, issued the SOFR Advance because it was a lot better index, and we support it as FHLBank as a system. And there's a strong market and it's gaining traction. It is the key there between LIBOR and SOFR is that SOFR is a secured rate. So where LIBOR is not, it's unsecured. So that's one of the big topics right now on transition to SOFR, and Fed funds has the same credit or lacks the same credit component. So that's one thing to keep in mind. On these advances for SOFR, they're great because they allow you to extend and have a longer term liability, yet they'll adjust daily to SOFR, and when we get to the next slide, it will have rates. But they will correspond, depending on the tenure, to say our line of credit or other short-term indices at FHLB. So when pricing loans, that's something to keep in mind. It's great to fund variable assets. A lot of members have been using these. The derivative markets really transitioned to SOFR. Derivatives have really indexed. A lot of derivative trades have really increased. So we're starting to see more commercial loans being swapped and funded using SOFR instead of LIBOR or Fed funds, and even prime. So we think that's where it's going, and educating your customers on this and getting ahead of it before 2023 is a good idea. Making sure they understand the index and that it's the right index for you. So a little brief fact, and SOFR has correlated to, or I guess Fed funds is correlated to LIBOR 87% of the time since 2000. And prime has correlated, I think it's 88% of the time since 2000. So there's a very close correlation, but in September and October of 2008, there was a huge 310 basis point delta between the two. And that could get a lot of people in trouble. So we plan on SOFR being a good fallback, but it still does have some shortfalls. And we'll go on to the next slide, and we can see the rates here. So our line of credit today is 27 basis points. So you could lock in a SOFR advance 1 year term. It'll adjust daily. And SOFR today is 5 basis points. And then it would adjust to SOFR plus 22. So your rate today, if you took that down, would be 27 basis points, which would be the same as line of credit. And back to that correlation comment, this SOFR product should correlate closely to our line of credit. So if you need that longer term liability, it's a good product to use. And SOFR, I guess I forgot to mention, SOFR has been 1 basis point since March 11th of this year. And then last week when the Fed adjusted repo rates and IOER, increased them by 5 basis points. That's why SOFR is now 5 versus 1, and IOER is 15. So we expect it to stay around 5 for a while as well. So, and then my favorite thing to talk about is capital stock. As a cooperative, we like to share our income and put it back into your communities, not only in the form of our AHP programs and grants and other programs we offer, but we really want to pay you guys for doing business with us. We're funded by you, we're self-capitalized, and stock is a very key important piece to that. Class A membership. That's your ante. That's what it costs to be a member with FHLBank Topeka. And that is 1/10 of 1% of your assets. So, and it's capped at 500,000. So we want to keep that ante low. And right now we're paying 25 basis points on it. So that's still a great return. I don't know any other short term with similar credit quality that's offering 25 basis points on it. So we're still trying to keep that dividend fairly high. And where you really want to start using us, once you get over that, there's a hurdle, and we'll go into that later. But Class B activity stock, it'll support advances, MPF, and letters of credit all have a stock requirement now. We implemented the MPF stock requirement last year, and that is to broaden the cooperative concept. So for members who only use MPF, we feel like they should have a stake and receive some of that income for doing business with us. So we added a 3% capital requirement to that. And letters of credit, I think it was January 22nd of this year, we added, and although the capital requirement's very low at 25 basis points relative to the small fee on letters of credit, it is still viable. And again, we added that for the same reason we added MPF. Those who only use us for letters of credit should still get some of that income back. So as we generate more income, I think we pay out about 60% goes back to our members in the form of dividends. And we pay them quarterly in Class B stock, so that's the higher paying. So right now, Class B dividend is 5.25%. I'm not aware of any loans or any other investments out there that are paying that kind of yield with the credit quality we have and the reliability and consistency we've had in the past. We like to keep our dividend fairly steady and reliable, not fluctuate it. And you can see that historically, that we don't want to just take it to 8% and then drop it to 4%, right? We want to keep it relatively steady. We pay that dividend in the form of Class B stock, so you can determine based on your tax situation when you want to redeem the stock. And we will do exchanges and sweeps to stay in line with our regulatory capital requirements. And then we have our annual asset-based adjustment that will adjust what it costs to maintain your membership based on your 12/31 assets for the prior year. And then the stock reports, they're available electronically, either on members only, or we'll send an email. And here I really like this slide because it breaks out when we added activity requirement to MPF and letters of credit, kind of makes stock a little more confusing. So this slide really breaks out the capital requirement for each product and what that dividend benefit is to you. So say you get over your Class A hurdle, and we'll get that, I think that's the next slide, and you're funded, any activity with us is being supported solely with Class B stock. This is illustrating what your all-in dividend benefit would be. So if you took down an advance, our current dividend rate on Class B is 5.25%, and we always think it's a good idea to apply a cost to that capital contribution. It's not free, so we pick interest on excess reserves, right? That's a little higher, maybe Fed funds would be more appropriate, or maybe you could use internal cost of funds. Whatever that number is, we still think it's important you apply the cost of that capital. Because even though money is pretty much free right now, it won't be in the future. So you take the 5.25% dividend, subtract out whatever cost of capital contribution, in this case 15 basis points, because that's IOER, and that gets you a marginal spread 5.1%. Now you simply take that times the capital requirement, 4.5%, and so it's 23 basis points off your rate. And that's very important to remember when you're looking at other sources running for your deposit campaigns, CDs, specials, and looking at other alternative sources to factor in that dividend. And on NPF, that 15.3 nearly doubles the credit enhancement fee that you're already paid on selling those loans. We'll move on to the next slide. And we got a question last webinar we did on Tuesday about where can you find out if you need to purchase Class B or what your stock position is. Out on members only, there is a capital stock balance report, and it also breaks out the capital requirement right there under rate for each of the products. And so that will tell you what your current position is. And then the next slide we'll get in, I'll kind of back up, slow down, and we'll use the advances as an example. So this is using the impact of the dividend on the advance product. So on a $250 million institution, when we talk about that membership stock, they would have a Class A requirement membership stock of $250,000. So to figure out what that Class A hurdle is, what does it take for them to get into Class B stock? You just take that $250,000 divided by 4.5%, and you come up with $5.5 million. And that's your hurdle. So once you get over $5.5 million, you're purchasing every activity with us is supported solely with Class B. So we think that's very important. We don't want you to get right to that Class A hurdle and then stop using us, because you won't be getting that 5.25% dividend, the higher paying dividend. You can see that light blue line. I don't know if Derek has, that goes straight up, makes a 90-degree angle. Yeah, that's what I like to look at because it's on the margin. So once you get to 5.5 million, every advance, it makes it simple. Capital stock's very confusing. We know you don't have time to study it in and out every day like we do. So to keep it simple, just get over that Class A hurdle, and now every advance you do with us or NPF or letters of credit is solely supported with Class B stock, and you can see you're getting 23 basis points off. So then when you look at it as a weighted average rate between your A stock and B stock, that's that curved line in the middle. And so that's factoring in that lower dividend for the A stock. And then on the dark blue line will show you if you borrowed, say, I can't read it from this far. In this example, what is it, 40 million, you would receive $100,000 in dividend annualized, or 120,000, I think that says. But anyway, so we can run this for you and walk you through it in greater detail, but I just really like the simplicity of this and how it illustrates the benefit power of the dividend. And then blended funding. So this, we're kind of trying to throw in the capital requirements and stock in the middle, because we want to keep that in mind as you're pricing loans. Many of our members use the advance curve to price their loans, whether or not they take an advance, which is still a good idea. But on the blended funding strategy, since you have typically our members are flush with liquidity, obviously blending in those deposits is a great idea. You're going to increase your spread. So when competing with like other institutions or like Farm Credit, for instance, we've done a lot of strategies for members who are competing with Farm Credit, and we were able to win those customers for the member by using a few strategies we'll discuss later on. But it really is just all about managing that interest rate risk, right? And adding in that longer term liability examiners come in, you're illustrating that you know how to manage your interest rate risk, and you're not funding 100% of the loan with advances, just a portion. You just want to manage that interest rate risk on the long end. Lock in that spread, prevent some margin compression in the future. Because I think in 2018, I think it was, we saw some CD rates in the 3%. So things change so quickly that that's very important to remember. And adding that call option makes it even more flexible.
Yeah, for sure. I think I just kind of want to go back to that special again real quick, Michael. A great way, to either get more spread with the blended funding strategy, and get more flexibility with those call options. Let you handle the future.
One thing we're hearing across the board is when's this liquidity going to run out the door? Nobody knows. It could be stickier than we think. It could stay on. Right now, it appears it's going to stay on, but who knows? So it's cheap insurance to take down a low rate if you have the capital to take on advances, take down that low rate cost, because right now that's tightest to treasuries, so very low rates. And if you don't need it, then you can exercise your call option and get out of it without a prepay fee. Because call options are cheap right now because rates are low, right? So they're expecting not to. And here's a few strategies we can run for amortizing advances. In this example, we used a 10-year loan. So whether it be commercial, ag, hopefully no one's making 10-year auto, but I bet you we'll probably get there at this rate in a few years when they came out with a 7- and 8-year auto. But you're able to partially fund it. I think that says what, half or 600,000? So 60%.
50-50 blended funding.
Oh, it's 50. Yeah, I can't read that from here. Sorry. So yeah, 50-50. And you're earning a spread, and that loan that you would be making is at 4%. The advance rate 1.4, and so your spread over the life of that loan 314 basis points. It's 3.14%. Assuming that your deposit cost is 30 basis points. Here, this example we just want to show is customized, that we can do any structure, so we can align them up. Similar strategy, 75% funded with advances, 15-year loan, and you're still able to eke out 255 basis points. And then when you factor in the dividend on all these, when we say we don't want to quote you a rate with the dividend, because everyone's dividend position is different. So if this was fully supported with Class B stock, you would add 23 basis points at least for this quarter. And the more members that use us, the more we can increase that dividend and keep it reliable and steady. So in this example, you'll have a short funded. So we put a balloon on the advance. And so you're just hedging that the first 10 years on a 15-year loan and still squeezing in over the life of the asset. It's still 3%. And 292 over the life of the advance. Then I'll let Derek go into detail here. And another strategy is you can use a ladder of bullets, right? Because we mentioned earlier that amortizing have to be prepaid in full or called in full, where bullets can be prepaid in part or full. So laddering bullets is a great tool if you're funding more than one loan. And so you would want to add, this is an extreme example. We put 250 in each bucket. Not realistic, but it's just for illustration purposes. So on the 10-year, right, you want to fund that interest rate risk. You lock in that rate. Well, it's probably a good idea to add that call option because that's your highest rate at 176. And say you did a 10-year, 5-year. So 10-year with a 5-year call. In 5 years, rates drop, all things stay the same, rates drop to 1.14%, like it is in this example, then you can just refinance that rate, right? Lock in a 5-year rate, or you need to readjust your cash position, pay down a portion of that, or call a portion of that principal. Then you can do so, but we just suggest adding the call feature to the longest term in this strategy. And again, this is used for mainly, it can be one loan, especially if it's a larger one, but generally it's a pool of loans or securities.
Yep, and as like Michael was saying, this is kind of an extreme scenario, as bullets are just kind of, you can plug and fill holes on your balance sheet, but we just want to show you guys with this example, we can do, any sort of tenure and use a ladder and bullet strategy to help bring your overall rate down with a bunch of bullet advances.
Yeah, so if examiners are coming in saying you have a need to fill the 8-year bucket, then just take down one advance. And then we'll get back to the dividend, because that's something that seems to be overlooked quite a bit. So in the next example, we'll use, say, that 2-year bullet we had above that was at 49 basis points. This is just another way to look at it. Instead of taking the capital requirement times the dividend yield, it breaks it down in dollars and what your total interest would be. So in this example, you have $1 million advance. Your requirement, because you're being solely supported with Class B stock, so 4.5% capital requirement. So you'd have to purchase $45,000 capital stock, and so now your all-in proceeds are $1,045,000, and $1 million is going out the door. And then so your interest expense at 49 basis points for the 2 years is $9,800. Now, when you factor in, assuming that the dividend stayed the same, 5.25% throughout all 2 years, that would give you a return of $4,725. So it makes your net interest paid of $5,075. And then when the third one just shows that in interest rates. So your all-in rate there would be 25 basis points.
And now, just now on to our next strategy here, which just another thing that you can do here at FHLB. Probably not one we've seen the most of, but still one that we do see every now and then, is match funding, where you just 100% match fund your loan or asset with an FHLB advance. And again, this is kind of suited best for a pool of mortgages. Again, you can manage your interest rate risk by locking in spreads today and having that rate fixed over the life of the loan. And again, kind of used for any large agricultural, commercial, or residential loans. And here, we just another graph that we were showing in the blended funding scenarios. And in this scenario, you have $1 million advance for 10 years, with you guys earning or recharging your customer 4%, and then have that rate at a 1.425. You would lock in a spread of 258 basis points.
And if anyone ever needs these ran, we can run these and show these graphs to you. So you can call up the lending desk or regional account manager, and we can run specific examples for you so you can illustrate, because we can do a 5-year delay. Say you expect all this abundant liquidity to stick around for 5 years, 3 years, whatever, so we can delay principal payments for that long. Again, very customizable. So we're just showing you examples. Please call in for specific ones that fit your situation.
Yep, for sure. As Michael was saying, if you guys ever do want, us to email you these graphs or anything like that, just give us a call. You might have your kind of own model that does this for you, but if you want us to run it for you and send you these, we would be more than happy. We would be more than happy to.
And yeah, so speaking of excess liquidity, one of our most popular products right now has been that letter of credit. So letter of credit allows you to collateralize your public unit deposits. So you're kind of, instead of hurriedly running out, we have a AAA rating, and it's preferred amongst all of the state agencies, regulators, not only in our district, but in any other state we've ever issued a letter. And beneficiaries love it. We did a survey 3 years ago, and we used to fax the documentation to the beneficiary and member. Now we did it electronically at members' request. The survey resulted in members wanting to have that electronically sent, and then adding it to members only so they can submit letters, and a few other things we'll discuss on the next slide. But the letter of credit just gives you that added flexibility to collateralize the public unit deposits that you have. It's quick, easy, and efficient. So when you factor in the operational cost of pledging and unpledging securities, or forgetting about a call and having to hurriedly run out and buy a security, it just takes all of that out of it. It's just simple as filling out an application, sending it to FHLB, and we'll submit that letter, and we can do it the same day. Beneficiary gets it, and beneficiaries love it because they're not having to deal with pledging and unpledging and the documentation. So this really helps with your asset and liability management, because you're taking away those securities that you're having to purchase to collateralize the public unit deposits. And instead of purchasing a low yielding security that's eligible to be pledged to collateralize those public unit deposits, it gives you a lot more flexibility. You can purchase a different security, or you can reallocate that capital toward a loan.
For sure, and as
again,
Michael was kind of saying on that last slide, they're simple, and they're even more simple. Some of you may have noticed that we do have online submissions to our members only portal now as well. So you guys, can, I think it takes about 5 clicks of a button, and there's a little drop down menus, and that's it. You can have your letter submitted instantly, where you and your beneficiary, receive a confirmation email. And again, as Michael was saying on that previous slide, the forgotten call, no more scrambling around to get a last minute to purchase a low yielding security to pledge for these public unit deposits. Call us, or I'm sorry, email us in, email, or fill it out online and have your letter of credit done pretty instant. And again, just a very simple product that we have, and convenient.
Yeah, and so that survey I referenced earlier, it was, I think some of you on this have filled it out and submitted it, and the top 3 things were making the letter of credit, sending those electronically in secure email, submitting those online, making them easier instead of having to email them in, which you can still do. And the third one was being able to make online draws on your line of credit through members only. And that is we've accomplished this. So all those things can still be done over the phone, or you can go on members only to submit your letters of credit or draw on your line of credit. And on the next slide, we'll go over, we bring up member solutions because they're terrific and create a lot of great tools. Now, the letter of credit utilization strategy tool is what we presented back in, I think it was 18-19. If anyone attended the regional meeting in 19, we passed something similar to this out. It really breaks out, at that point, it was more liquidity was a situation, so why you'd use a letter of credit for liquidity. Now the rules have shifted, so we're not going to focus on that component in this analysis or tool. We'll go to the boost earnings. So it's showing you what the cost of the letter of credit is, so it's 12.5 basis points, compared to the security that you're purchasing, or what happens if you put that into a different security that wasn't eligible to be pledged as collateral to collateralize the deposits. versus one, yeah, that's not eligible. Or if you used that cash or capital to make a loan instead, what would that do to your profitability ratios? And at the bottom, and please contact Rams or Derek or myself, and we can run this analysis for you so it can illustrate what is actually your bottom line is. What's the best decision for you? It's not always the letter of credit, and we'll tell you that because our goal is to be your trusted financial partner. But we want to make sure you're aware of the options.
Sure, and just as Michael was just saying, our goal is to be your trusted financial partner, in all environments, all the time. So please, always again, feel free to reach out to your regional account manager, to us on the lending desk, for whatever it may be, no matter how big, how small, we are here to help you guys. So please always feel free to reach out to us with any questions. And on this next slide, I just kind of want to remind you guys, or at least let you guys know about some upcoming opportunities that we are hosting. And this first one here, the post-pandemic consumer and how to bank them, webinar by Joe Sullivan at Market Insights. That will be July 20th. And then also we are kind of proud to announce that our regional meetings, those will be held in person for all of our states, Colorado, Nebraska, Kansas, and Oklahoma. You can see the dates there, and registration for those begins in July. There will be emails and communications sent out about those, so definitely be on the lookout for those.
One thing to remember too is being part, your membership with FHLB, everything on this slide is free. So if you can attend, please send to a regional meeting, for instance. The webinar is free, but if you can't attend a regional meeting, send someone else that's at your office, right? That deserves it. So we'll do a morning session, will be educational, and then we'll have golf. And this year we're doing something a little different for those that don't play golf, and we're gonna try to figure out how we can help a local charity in your community. So that'll most likely entail packing backpacks with school supplies, toiletries for homeless shelters, or other various strategies depending on what we're gonna get. We sent an email out, I think it was yesterday or on Friday, to get feedback on what you all want to do in your area. So please fill out that survey.
Yeah, just another kind of awesome thing, that we're doing, to help, you guys out and to be involved in your communities. All right, last but not least here, we just kind of want to, give you guys all of the Rams information, or your Rams information, and Michael and I's, if you don't already have it. And one thing I do want to kind of point out on this in particular, because it is fairly new, is Mr. Trent Meyer is now going to be taking over the Nebraska region and parts of Northeast Kansas, as Mr. Woida is retiring later this year. So congratulations to both of them. And then also in the meantime, Trent is the Oklahoma's regional account manager. He still will be working with you guys while we're looking to fill that role. So, again, please feel free to reach out to him or us on the lending desk. And, we would be glad to help you guys.
Yeah, we tried to cover a lot in this webinar. So the main intent is please reach out. If you have any questions, we understand you don't have a lot of time to sit there and study FHLB. So use us as a resource. We might not always have the solution, but we should. We'll have a solution. And we can discuss strategies or other ways that you can benefit not only in the short term, but the long term. And we did get a question on what is a test your line transaction. A test your line transaction started, 10, 15 years ago, and it's just simply borrowing on the line of credit for one day, and we'll call the lending desk, tell them you want to do a test your line. In 90% of the time, it's the minimum $100,000, so 27 cents. And we'll reverse that the following day, and we'll send you documentation, a letter, and it'll say who's all eligible to borrow at your institution, and then a collateral capacity analysis to show how much collateral you have available. And then examiners, for some reason, they really like having that in your contingency plan. So you can illustrate to them who's eligible to borrow, how much more collateral do you have, and then that also helps ties back into that contingency plan. So it's really just something we suggest doing those annually. And my comment earlier about me not thinking that's enough anymore, because the money doesn't go out the door. Typically, it stays here. And to me, the most important part is that money flows out the door. Like that wire is the key, right? And so having who's authorized to make sure you can get that money in times that you need it. And I think that the examiner's heightened focus on liquidity and interest rate risk, I don't know if test your line is just going to be enough. I think illustrating that you know how to manage interest rate risk, whether or not you take a $10,000 bullet advance, right? Participate in the special, it's 10,000, the minimum is 10,000. So just illustrating that and having a more robust paperwork to illustrate and support your contingent plan, because you won't get hit up on the sensitivity piece when they come in to examine.
Yep, for sure, and a great question. Thank you for that. And we do have a couple more minutes here. If there are any other questions, please feel free to throw those into the chat or the Q&A box, and we'd be happy to answer those for you guys. One thing I do want to mention too is I got a chat saying that my audio seemed to be going in and out. I do want to apologize to you guys for that. We tested and tested before, but I guess this technology was not on my side today. So just again, any questions after the webinar, our information is on the screen. So please feel free to reach out to any of us.
Yeah, and we just want to make sure you're aware of everything available with you, so we do not mind. Please, please, please call if you have suggestions on specials. Derek and I are in charge of that. So if you'd like to see a product, maybe we could put something together, whatever needs you're seeing. We also, if you just want to call in and tell us what you're seeing in your area, that's great and helpful for us. And the slides will be available. We'll post them out there after this session, probably tomorrow.
Yeah, either tomorrow or Monday, our marketing team will have them out on our website available to share to other people at your guys' institutions.
Yeah, but again, we cannot solve everyone's situation's unique and different, so please don't hesitate to call.
Alrighty here. Well, I'm not seeing any other questions. So just for one last time, I do want to thank you guys for your time, and thank you for joining Michael and I. We greatly appreciate it. We hope you appreciate it. And again, can't say this enough. If you do have any questions, no matter how big or small, please feel free to reach out. And once again, thank you for your time today.